Okay, we got Easy Financial. What is going on here? We have Easy Financial. The stock price fell 50% in one day. Is this the private credit contagion? All right. So, what am I talking about? What's private credit? All right, let's talk about it. So, there's a difference between institutional credit and private credit. So it's really simple. A deposit-taking, federally regulated organization, a bank, maybe a credit union, even though they're provincial, they're deposit takers. They're under continual scrutiny. They're almost all well established. They've been around forever, and they're here. They're going to stay. We're not worried about them. Yeah, whatever you do, don't think the private credit problem applies to banks. It does not. But let's talk about what the hell private credit really is. So private credit is all the stuff that's not deposit taking. It's all about, okay, you could be as small as a little private mortgage operation. It could be that. It could just be a little $20 million, $30 million mortgage investment corporation. It could be a huge mortgage investment corporation like Romspen. Hey, that's not so hot over at Romspen. I mean, a few $1 billion, but it's gated. You can't get your money out. Distribution going south. All right. So what's with Easy Financial? That the stock tickers go easy, and 50% drop. Why? What the fuck's going on? Okay. They're restating earnings from over a year ago. What? What sense does that make? Okay. Not just that, but 2 years ago, the CEO up and quits. Boom, I'm out. Goodbye. And then they're searching around and they find a new CEO and he starts, and 6 months later, oh, I quit. I'm gone. And so what's going on over there? All right. So they're restating all these earnings, and everybody just puts their hands in the air and says, I think something's wrong. Okay. Really simple. I think something is wrong, because you don't want to see the CEO of an independent financial lending organization both quit within the same 2-year period. I mean, you don't want one CEO after another just fleeing. That ain't good. So what is the problem with private credit? All right. The idea behind private credit is very simple, that banks achieve their profit through a spread. Now, banks do a bunch of other stuff. They do banking. They just do plain old day-to-day banking. They do capital markets, huge capital markets operations. They have huge wealth management operations. They're diversified. They have many things that they do. But in lending, they work on a spread. All these companies have is just lending. They don't have any of the other diversified things. They're not deposit takers. They depend on outside investors. And the idea here is, hey, if the bank can take a spread, the difference between what we get our money in for and how much our money costs us to get and how much we put it out for to our borrowers, well, if we can work on that spread, we're going to make money. It's like a 600-year-old thing, okay? Right back to the Medicis in Italy. So what the fuck is going on here? Well, it's like this. All this stuff in private credit works okay, not necessarily perfect, but okay when times are good, when the economy is pretty good, when interest rates are really low, like the 13 years of low interest rates we had after 2009, and when the economy is not struggling, particularly when real estate is not struggling. Because even though these loans are not necessarily about real estate, in the end, if you're lending to a homeowner, they could usually find a way to get a HELOC, to get a second mortgage, and they could pay out your loan, okay? Or they could pay out the car loan that was killing them. But when all that dries up, when it all disappears, there's no liquidity. Liquidity is when there's availability to get your hands on some more money to deal with the issue you have to deal with today. So if that is all contracted, if that's shrank, if it's harder to deal with any problem that comes up, then that's when private credit goes to rat shit. I mean, all over the world, we've had failures in private credit. We had like $1 billion Canadian go boom in Britain. Yeah, that was crazy. They were doing fraud over there. They were saying, hey, you give me some money and I'm going to give you this loan as security. But what if they told that to 3 different people? 3 different other companies. They said, yeah, we'll give you security. Well, wait a second. You're telling me the same security, you're lying to the other two? Like, what's going on here? This is crazy. Then we've had the blow-ups on, interestingly, subprime car in the U.S., subprime auto in the U.S. just blown to smithereens. They were doing the same thing. They were giving the saying, oh, I'll give you security on this car, you security on the same car, and you security on the same car. It's all just bullshit. So that's blown up. We've had the gating of a bunch of the big funds like BlackRock, Blackstone. There's issues over there. So what's going on here? Really simple. Same thing. Now, Easy Financial is blaming this on the acquisition of a automobile lending company, out of a car loan company. But that was like 5 years ago. So what's going on right now? Look, these things all boil down to the same thing. They boil down to too much arrears, too much default on loans, not really pricing what the value of the security is. Like if you've got a used car, how much is it really worth? Are you using values that you're enthusiastic about, or are you using the values that would be the worst case scenario? And not just that, but do you have a good way to get the cars back? Like in this thing of doing subprime loans, there's a lot of technical things you have to do to be able to grab the car back in an efficient, effective manner. What if you're not doing those things? So all I'm saying is that when economic times are okay, when real estate's doing okay, because it's the backbone of supplying families with access to money, access to credit, then other things move along. And by the way, it's not like anybody didn't look at these loans and say, hey, you're charging 30% on loans, 29% on loans. I think that's a little high. People must be desperate. Is it good to lend only to desperate people? So when the economy contracts, when unemployment starts to build, these private credit operations can just blow up to smithereens, okay? They might not even be doing a single wrong thing. They might not be doing any accounting tricks. But in the end, if it gets going backwards, you can't save it because there's no new money coming in to fix it.